Welcome and thank you for joining today. We are diving deep into understanding how to read volume in trading, and I am really excited to take you along for this ride. By the end of our time together, you will know exactly how to interpret volume, how it connects with price movements, and how you can use it to make better trading decisions. Stick with me because there are some powerful insights coming up that might just change the way you look at trading entirely. Have you ever wondered what really drives the movement of prices in the market? It is not just about the price itself, but about the story behind the numbers, and that story is told by volume. So what exactly is volume in trading? Well, volume is simply the number of shares or contracts traded over a specific period of time. Imagine you are watching a busy marketplace with people buying and selling items. Volume in trading is a lot like counting how many people are actively buying and selling in that market. It helps you see how much activity is going on and whether people are really interested in those items or not. Volume is one of the most important indicators to help traders understand if a trend is strong or if it is just a little blip that might not last. When volume is high, it shows that many people are interested. When it is low, it means there is not much activity. It is almost like listening to a crowd. The louder it is, the more people are involved. Now, let us expand a bit on how volume interacts with different chart patterns. Understanding chart patterns is key because they provide visual signals that traders use to make decisions. Some of the most common chart patterns you will encounter are head and shoulders, double tops and bottoms, triangles, and flags. Each of these patterns can be better understood by looking at volume. Let us start with the head and shoulders pattern. This pattern is typically seen as a reversal signal, and it is made up of three peaks: a higher middle peak, the head, and two lower peaks on either side, the shoulders. Volume plays a critical role here. During the formation of the first shoulder, volume will often be higher as the price moves upward. When the head forms, volume may begin to decline, indicating a potential weakening in the trend. Finally, during the second shoulder, if volume continues to fall, it suggests that buyers are losing interest and a reversal could be on its way. Next, let us talk about double tops and double bottoms. A double top forms when the price reaches a high point twice but cannot break through, creating two peaks at roughly the same level. The volume should be higher on the first peak and lower on the second peak, which suggests that the buying interest is fading. This weakening volume is a signal that a reversal might be approaching. In the case of a double bottom, it is a similar idea, but in reverse. When the price hits a low point twice and volume is lower during the second dip, it can indicate that the sellers are losing strength and a reversal upwards might be imminent. Triangles are another common chart pattern, and they come in three types: ascending, descending, and symmetrical. In an ascending triangle, volume often decreases as the price moves between support and resistance, forming higher lows. When the price finally breaks out of the resistance level, a significant increase in volume can confirm the breakout. The same principle applies to descending triangles, where a breakout below support with rising volume confirms the move. In symmetrical triangles, volume tends to diminish as the pattern forms, and then a sharp increase in volume during the breakout helps confirm the direction of the trend. Flags and pennants are continuation patterns, meaning they indicate that the price is likely to continue in the same direction after a brief pause. These patterns are typically accompanied by a strong trend with high volume, followed by a period of consolidation where volume drops. When the price eventually breaks out of the flag or pennant, You want to see volume increase to confirm that the trend is resuming. If volume is weak during the breakout, be cautious. It might not be a strong move. By paying attention to how volume behaves during these chart patterns, you can get a much clearer picture of what is happening in the market. Volume is like the fuel behind price movement, and when you match volume with these visual patterns, you have a powerful combination to make informed trading decisions. Let us break down how you can read volume with price movements by looking at how volume plays a crucial role in understanding market sentiment through different chart patterns. When the price goes up and volume rises at the same time, that is often a sign of a strong uptrend. It means a lot of people are buying, and they are pushing the price higher, indicating genuine strength behind the move. This kind of move is often seen in continuation patterns like ascending triangles or during breakouts from consolidation phases. But what if the price goes down and volume is increasing? That usually tells us that the sellers are in control and that the downtrend is strong. It suggests that more participants are actively trying to exit their positions, adding to the selling pressure. This is commonly observed in descending triangle formations, where the support breaks and volume increases, confirming that the bears are gaining control. Now, if you see the price moving up or down with very little volume, that is a weaker move. It might not stick around for long, as there is not enough interest or commitment from market participants. This often happens during flag or pennant patterns, where volume typically decreases during the consolidation phase. It could mean that people are unsure, or maybe just waiting to see what happens next. It is a bit like when you see someone dip their toe in the water before jumping in. They are not quite sure yet, and the same uncertainty shows in the weak volume. To get a better understanding of how price and volume relate, always watch how volume behaves during key price levels such as resistance and support zones, or when the price approaches chart patterns like head and shoulders, double tops, or symmetrical triangles. In these situations, volume acts as a confirming factor, either validating the strength of a move or suggesting that it could be a false breakout. Observing these dynamics in different chart patterns gives you a more nuanced view of the market's intentions and helps you make more informed trading decisions. Now, let us talk about something that is always fascinating to spot: volume spikes. These are moments when trading activity suddenly surges, and they can happen for a lot of reasons. Maybe some news came out, or there was a big announcement that caught everyone's attention. Volume spikes can mean big changes are on the way, and they are often crucial moments for traders to take note of. For example, if you see a volume spike when the price is breaking through a resistance level, it is usually a strong signal that the buyers are really committed and that there is a lot of energy behind the move. It means there is significant interest in pushing the price higher, and the breakout is more likely to be sustained. The same idea applies to support levels. If the price hits a support level and there is a spike in volume, it often means that sellers are stepping in forcefully. This suggests that the price might continue downward with strong momentum. Volume spikes can also signal reversals or shifts in market sentiment. When a volume spike occurs during a prolonged trend, it can sometimes mean that exhaustion is setting in. For instance, if an uptrend is met with a volume spike, but then fails to push the price significantly higher, it could indicate that buyers are losing steam and that a reversal may be approaching. Similarly, in a downtrend, if you see a spike in volume but no new lows are being made, it might signal that sellers are losing their grip and a turnaround could be near. Another situation to pay attention to is when volume spikes happen around key price levels. These levels could be areas of support, resistance, or even trend lines that the price has respected in the past. When you see a sudden surge in volume at these critical levels, it can often signal that the market is making up its mind about the next big move. This is why when you see a volume spike, you should pay close attention. It could be the beginning of a significant change, a strong breakout, or even a reversal of the current trend. By closely observing volume spikes in relation to price action, you can gain valuable insights into the intentions of the market participants. We can also use volume to confirm trends. Let us say you are looking at an uptrend and you notice that volume is growing as the price moves up. This tells us that the buyers are really driving this trend, and it is likely to continue. On the other hand, if the price is falling and volume is getting stronger, the sellers are in control and the downtrend is solid. But if you start to notice that volume is dropping during a trend, it might mean that the trend is starting to lose steam. This is the point where you need to stay alert. A reversal or a pause could be on the horizon. Another really important concept is volume and breakouts. When the price breaks through a key level of support or resistance and you see high volume, it usually means that the breakout is real and could keep going. High volume means there is a lot of interest in that move, and it is more likely to continue. But if the breakout happens and volume is low, watch out. It might be a false breakout, and the price could just slide back into its old range. This is why volume is so important. It helps confirm whether a move is real or not. Next, let us think about how volume can help us spot reversals. This is one of the most exciting parts of volume analysis. If you see a volume spike at a support or resistance level, it can often signal a potential reversal. Imagine the price reaches a high point and you see a big volume spike, but then it stalls. It could be a sign that the price is about to turn around and head in the opposite direction. Another thing to watch for is divergence between price and volume. If the price keeps going up, but volume is getting weaker, it could mean that the uptrend is losing strength. This divergence is a clue that a reversal might be coming soon. It is like the crowd is starting to lose interest, even though the price is still climbing. There are also a few indicators you can use to help you get deeper insights into volume. One popular one is on balance volume. On balance volume adds volume on the days when price goes up and subtracts volume when price goes down. It is a good way to see whether money is flowing into or out of a stock, and it helps confirm the direction of the trend. When on balance volume moves in line with the price, it confirms the trend's strength. However, if price moves up while on balance volume moves down, it could signal that the trend is weakening. Another indicator is the volume oscillator. This one compares short-term volume to long-term volume. If you get a positive reading, it means that the short-term volume is higher than the long-term volume, which can signal momentum building up in the market. A negative reading could indicate that the enthusiasm in the market is decreasing. The volume oscillator is helpful for understanding when the volume is deviating from the average, giving you insight into whether the current move is likely to sustain or fade out. The accumulation distribution line is another useful tool. It measures buying and selling pressure by comparing price and volume. If the price is rising, but the accumulation distribution line is falling, it could mean that people are actually selling despite the price increase, which could be a warning sign of a potential reversal. Conversely, if the price is falling but the accumulation distribution line is rising, it could mean that buying pressure is building, even if the price action does not yet reflect it. This divergence can help you spot potential turning points before they become apparent in the price action alone. Another powerful volume-related indicator is the Money Flow Index, often called the MFI. The Money Flow Index uses both price and volume to measure buying and selling pressure, similar to the Relative Strength Index, but with volume incorporated. If the MFI moves above a certain threshold, it can indicate that an asset is overbought, while a move below a certain level can indicate that it is oversold. Watching for divergences between price and the MFI can help signal possible reversals or trend shifts. The Chaikin money flow is also an effective volume-based indicator. It measures the accumulation or distribution of an asset over a certain period. When the Chaikin money flow is positive, it indicates that there is buying pressure, while a negative reading indicates selling pressure. The strength of this indicator lies in confirming trends and identifying shifts in momentum, particularly when it aligns or diverges from the price movement. These indicators can really help you add another layer of understanding when it comes to reading volume. By combining these tools, you can confirm trends, spot divergence, and gain a deeper perspective of the buying and selling dynamics driving the market. Remember, volume is not just a number. It tells the story of participation and interest, and these indicators help you decode that story in even greater detail. Let us talk about some trading strategies that use volume. One strategy is to follow the trend. If the price and volume are both rising, it is a good signal that the trend is strong, and it is often a good opportunity to ride the trend. When volume accompanies the price move, it means that many participants are backing the movement, increasing the probability of continuation. However, if you see the volume start to fade, you should be cautious because it could mean the trend is weakening, and it might be time to tighten your stops or take some profits. A fading volume indicates that fewer participants are interested, which makes the current trend vulnerable to a potential reversal or consolidation. Another strategy is breakout trading. This is when you enter a trade as the price breaks out of a key level, such as a significant support or resistance area, a trend line, or a chart pattern like a triangle, rectangle, or even a wedge pattern. Breakouts are often accompanied by a surge in volume, and if the breakout is supported by strong volume, it is a sign that the move is likely to continue because it shows commitment from traders who are pushing the price in the breakout direction. Breakouts without volume can be risky, as they may indicate false moves that could reverse quickly. These are known as false breakouts or fakeouts, where the price briefly breaks a key level only to fall back into the previous range. The presence of strong volume gives credibility to the breakout and can make it a more reliable trading opportunity. In fact, some traders like to wait for a retest of the breakout level, combined with strong volume, to further confirm the validity of the breakout. This retest gives traders more confidence that the breakout is genuine. When trading breakouts, it is also useful to monitor whether the volume is building up as the price approaches the breakout point. Increasing volume leading into a breakout is often a positive sign, as it indicates growing interest and accumulation by market participants. Another important aspect to watch for is the type of chart pattern leading to the breakout. For instance, ascending triangles often break to the upside, while descending triangles typically break to the downside. Symmetrical triangles can break in either direction, so observing volume build-up helps provide a clue about the likely direction. Breakout trading can also be applied to smaller patterns like flags and pennants. These are continuation patterns that often form after a strong price movement and indicate a brief period of consolidation before the trend continues. A breakout from a flag or pennant with strong volume confirms that the trend is resuming. The size of the initial price move, often called the flagpole, can be used to estimate the potential target of the breakout, giving traders an idea of the reward to risk ratio of the trade. To successfully trade breakouts, understanding the interplay between price action, chart patterns, and volume is key. Watching volume dynamics and waiting for clear signs of commitment can make a huge difference in identifying genuine opportunities versus false signals, ultimately increasing the likelihood of successful trades. Finally, there is the reversal strategy. This involves looking for volume spikes near key levels of support or resistance, and then watching for a price reversal. Volume spikes are important because they often signify a climax of buying or selling pressure, which can indicate a turning point. For instance, if the price reaches a resistance level and you notice a significant volume spike, but the price struggles to move higher, it could suggest that buying pressure is exhausted and a reversal might be near. Conversely, if the price hits a support level and there is a sharp increase in volume, but the price cannot push lower, it might indicate that selling pressure is losing strength and a reversal to the upside could be approaching. Combining volume analysis with price action at these levels can provide powerful insights into the market's next moves. Another useful technique in reversal trading is to look for divergence between price and volume. For example, if the price is making new highs but volume is decreasing, it could mean that fewer buyers are supporting the upward movement, which can be a sign that the trend is weakening and a reversal is likely. The same principle applies for downtrends. If the price is making new lows but the volume is fading, it could mean that sellers are losing control and a reversal to the upside could be imminent. Paying attention to these divergences helps you prepare for potential market turns before they are evident in price alone. Now, a quick word about risk management when trading with volume. It is important to use volume levels when setting your stop losses. For example, if you are trading a breakout and there is a volume spike, place your stop just below the breakout level. This way, if the breakout fails, you have some protection. Also, think about your position size based on volume. When volume is high, it suggests stronger moves, so you might consider taking a larger position. When volume is low, it means there is more uncertainty, so it makes sense to reduce your position size to manage your risk. Before we wrap up, I want to mention a few common mistakes that people make when reading volume. One big mistake is ignoring volume during key moves. If a price move happens without strong volume, it might not be reliable. Another mistake is overreacting to small volume spikes. Not every spike means a major change is coming. Always look for confirmation before you make a move. And finally, relying only on volume without using other indicators can be risky. Volume is a powerful tool, but it works best when used alongside other tools like moving averages or trend lines. To sum it up, volume is an incredible tool for understanding the market. It helps confirm trends, signal breakouts, and spot potential reversals. By paying attention to volume, you can add a lot of confidence to your trading decisions. I encourage you to start using volume analysis as part of your strategy. Watch for those volume spikes and use volume to confirm your trade setups. Keep practicing, and over time, you will get better and better at spotting those high-quality trades. I would love to hear your thoughts on using volume in trading. Have you tried it before, or do you have any questions about what we covered today? Feel free to share what you are thinking. Keep practicing and stay curious, and soon enough, volume will become one of your favorite tools for understanding the market.